This is the sixth in a series of videos about model-guided core options trading strategies. In the fifth presentation of this series, we gave exclusive attention to put option credit spreads, believing those to be more commonly used than all other vertical spreads combined. This video primarily discusses call and put debit spreads, but we also have an example of a call credit spread since that was not discussed in video 5. Your time is valuable, so let's get to this. Here are some key questions that we're going to answer. First, what is a debit spread and what is the significance of the word debit? When would you use a call or put debit spread? What kind of payoff pattern does such a bet have? And why are these so popular with young traders? That'll be a very interesting answer. How do debit spreads impact risk? When are calls used and when are puts used? Why would you use either? And then finally, is there an algo or computer-assisted trading algo, what we call a kata, that we can use? And remember, a PDF duplicate of this slide set for your review is linked below and on the old Harvey Mudd Econ 136 website that has links to all related material. So you may want to look at that after watching this video or even before watching this video. To continue, we're going to answer the last question first. Is there a kata computer-assisted trading algo that we can use or that I'm providing you? And the answer is yes. There's a preview of what it looks like, part of it, not all of it, and the mapping on the left side of this page. The two models are one for debit spread mappings, what I call the quick and dirty version. Then there's another for credit spread mappings, also quick and dirty version. And by that I mean, by the way, that these models do not include currently delta calculators or estimates of in the money, as they later will after we cover theory. These are largely mapping models that allow you to see the payout of the bet as shown on the bottom of the image on the left. I also want to remind you, if you're going to use these mapping models, that they require our financial utility version 2.9 or higher, and that was uploaded with this upload. So if you have an older version, these models won't work with that. And it also requires a very current version of the time utility model, which is version 1.5 or higher. Now, all of those are provided in a zip and a PDF, and so you can decide which, if anything, you want to pull down. But if you pull down the debit and credit spread mapping models, make sure you pull down the financial and time utility with it because they're accessed from the program. Now, we need to review some definitions to remind ourselves of what we're talking about. First of all, a spread is a two-legged option bet consisting of the primary bet, which usually involves writing a naked call or put, and a hedge or a cap, which involves buying a call or put of the same underlying at a different strike price or a different expiry. Now, in this series of lectures, we're talking about vertical spreads. If the two options in the spread have the same expiration date, that is called a vertical spread. If the two options have different expiries, that is called a calendar spread, and we'll cover calendar spreads at a later time. When you write one option and buy another in a vertical spread, if the option that you write is more expensive than the option you buy, this is called a credit spread, because your cash account will be credited, that is, cash added to it, at the beginning of the transaction. And that's what we discussed in the last slide set. If, on the other hand, the option that you buy is more expensive than the option you write, this is called a debit spread because your account is debited with the difference. And that's what this video concerns itself with. Remember, Two of the primary purposes of options contracts are to leverage a bet or to hedge another bet, and spreads often combine both of these objectives. Now, before we talk about the classifications of debit spreads, we need to qualify a few things about these mappings, as we always do. So this is actually a mapping of a put-bull credit spread that was provided in the last lecture for SPY 3 days out. Here's what you need to remember about these mappings. First, they show the range of payoff that would result only at expiry. Theoretically, though, because you are taking advantage of the net premium available from a short bet, you should hold this full bet until expiry to get maximum gain, because time decay erodes the premium. However, that's qualified because to avoid assignment risk, it is usually wise to exit the entire bet no later than the penultimate day before expiry, or whenever you hit a profit target that is less than the maximum gain. All of this implies that the maximum gain realized will be a little less than indicated by the model. And again, I remind you, these mappings do not include fees, because that would simply compound the calculations, and the fees for these are not very high. Now, let's remind ourselves of the construction of the put credit spread, looking at the example of a put credit spread for SPY that we used last time. And so in that example, the trade with SPY was when SPY was at 329.22. So the first step was to short or sell to open the 329 put at $2.08. The second step was to hedge long or buy to open the 326 put at $1.13, and that was more out of the money in our example. You are credited the spread immediately, in this case 95 cents, and that is also going to be your maximum gain. If the stock expires below the hedge strike, 326, your loss will equal the spread plus your credit. In other words, in this example, a loss of $2.05, and that will be your maximum loss. And again, we remind ourselves that although we're using puts, this is a bullish bet. We want the stock to drift in the direction of the arrow, and we also have a greater than 50% probability of a max gain, because all of the strikes are to the left of our stock price, and we know that our stock price is more or less centered on 50%. Traders often set these up using deltas. For example, selling the put at 0.45 absolute value delta and placing the hedge at 0.25 absolute value delta. We saw that example of the put credit spread in the last video. Now, in contrast, let's look at an example of a call credit spread for SPY, because we didn't talk about call credit spreads in video 5. Look at this. It's fairly simple to see what's going on here. The trade is with the underlying SPY at 322.23. You short or sell to open the 323 call, which is out of the money, for $2.18. You buy to open the 326 call for 93 cents. That's more distant from the money. You are credited the spread immediately, and that's $1.25, and that will be your max gain that you can realize from this trade. And if the stock expires above the hedge strike, 326, your loss will equal a spread plus your credit, equal to this case for a loss of $1.75, and that's going to be your max loss. This is a bearish bet. We want the stock to drift in the direction of the arrow, and we also have a greater than 50% probability of a maximum gain. Now, these kind of bets, the call bear credit spread, are not made very much, because this is typically a contrarian bet that is being made against the market. So they're clearly not going to be as popular as a put bull credit spread. but this is what they are. Okay, that's enough of a review, so let's switch to debit spreads, the primary subject of this video, starting with an example from AMD. AMD is a stock in 2020 that's had a good run, very popular. As you can see on the graph on the left, they had a recent very robust and positive earnings report, as you can see from the 2-day candlestick chart on the right. And this stock is very well behaved statistically, as you can see from our Gaussian histogram on the bottom. So let's start with AMD as a candidate. Let's use this option chain. This is the July 31st expiry we're looking at here, and this was taken on July the 28th, 2020. If we look at it closely, we can see that it is indeed for AMD, and we have a 3-day chain we're looking at here. You can see that it's very dense, with strikes $1 apart. And you can see at the time we did this, the moment we did this, in fact, that AMD was 67.72. So let's do a put debit spread for AMD, and selecting from that option chain, because it's a put spread and we want the options to be out of the money, we're going to select the quotes for the 65 and 67 puts as shown here. And you can take a quick look at the graph. We have the stock price represented as green. We have the long strike represented as an orange dotted line, and the short strike as represented as the red dotted line. And here's the procedure. The underlying was trading at 67.72 when we did this. So step 1, buy the 67 put for 239. That's close to the money, out of the money. Step 2, short or sell to open a 65 put for $1.55. That's more out of the money. And for reasons we'll explain, this is not a hedge. This is actually a cap, and we'll have to explain that later. You are debited the net cost immediately, which is 84 cents. And so that is taken from your account, and that also ends up being your maximum loss. You won't make a loss larger than the initial cost of going into this trade. If the stock at expiry is below the short strike, 65, your gain will equal the spread minus your deficit. That's $1.16, and that is your max gain. And you can see in this example that that's more than the maximum loss. But we have an interesting question. We said this is a cap and not a hedge. Well, why would you want to put a cap on this trade? Because after all, if you simply took step 1 and bought the 67 put for 239, then of course, if the stock went below 65, you would continue to experience increasing gains. Imagine what this chart would look like if the blue line continued to 60. It would be off the chart. It's clearly not a hedge. You're not reducing your risk by taking the short position. So we're going to have to explain that here, one way or the other, in just a minute. Let's first look at a call debit spread for AMD. Looking back again at our choices of strikes and prices, the stock price is 67.72. Because we're looking at a call here, we want to look at two options like the 68 and the 71, so let's choose that. We see the stock price represented by the green line, the long strike close by, the short strike represented by the red line, more distant. Let's evaluate the trade. And by the way, when I say in this that you go long in one, then short in the other, you probably know that it's possible to enter these contracts as spreads per se, which means you give your broker some latitude for choosing the call and the put based upon the spread value that you're submitting as a market order or a limit order. You can also choose, however, to do them one leg at a time, and that's the kind of example that I'm using here. I do them one leg at a time because I think I get price improvement doing them one leg at a time, although I pay a slightly higher fee when I do it that way. Okay, we begin this with a long buy for $2.63 at the 68 call. That's close to the money, but out of the money. We do a short sell at 71 for $1.53, again more out of the money, and again this is a cap and not a hedge. And so you are debited the net cost immediately minus $1.09, and that is your max loss, and that's where you start because you start with a debit, unlike the credit spread where you start with a credit. And if the stock at expiry is above the short strike, 71, your gain will equal the spread minus your debit, or $1.91, and that's going to be your max gain. And clearly this is a bullish bet. We want the stock to drift in the direction of the arrow. And again, the max gain is greater than the max loss. But again, we ask the question, especially with the call spread, especially with the performance we've seen of AMD all year long, why would you want a cap on this? It clearly is lowering the price of getting into this option trade, but the price of getting into this option trade wasn't all that great if just looking at the long side. It's only $263 per contract, and almost anyone could afford that. Well, the answer is you would never do this on a stock like AMD. This kind of strategy is reserved only for certain circumstances. For example, what if we wanted to buy a call on Tesla? Now, the example I'm about to provide was based upon Tesla prices on August 4th, 2020. It was a couple of weeks before Tesla split their stock 5-1, and that happened on August 31st, 2020. What if all along you had simply wanted to buy a call on Tesla instead of AMD? Well, first of all, we know that we have a very dense set of expiries and strikes. And look at this chain. This chain's not even close to complete. It's only the middle of it. Here we are looking at Tesla calls and puts that are 10 days out for August the 14th. But the reason that we may not be able to trade this is because Tesla isn't trading at $65 like AMD. Tesla's trading at this time for $1,468.75 at that moment. And again, that was before their 5-1 stock split. To evaluate this, once again, let's take a small selection of strikes out of the middle of this chain and work with those. So, for example, we see that if Tesla's at 1468, we're looking at $5 strikes. There were $10 strikes at 45-day contracts and later. Well, we can see that if you wanted a 100-share call contract, that's going to cost as much as $6,000. Google, Amazon, and a lot of other popular stocks are in this category. So it's very clear when looking at this, although we might be able to afford a 100-share call contract for AMD, which is only going to cost, say, $400 or so, maybe not so much for Tesla because the equivalent here costs $6,000. So what can we do? Well, perhaps we can do a call debit spread instead. That will make this contract affordable. So take a look at our selection here for a call debit spread for Tesla and take a look at the graph. We have the stock represented at 1468.75, and our long strike will be a 1470, for which we paid 58.50. And as you can tell by looking at the wide spread between bid and ask, I'm taking a more or less centered peg for that. It does not mean we could actually get that price with the limit order. We're just assuming here that we can. So we buy the 1470 call for 58.50. Now that alone by itself would cost $5,850. But we also sell to open or short the 1480 call for $53.85, and we get for that a $5,350 credit. Remind ourselves that we are not hedging anything by doing this. This is actually a cap. But the benefit, of course, is that you are debited the net cost immediately, but that's only $4.65 a share, or in other words, $465 per contract, about the same as the AMD contract, and that is going to be your maximum loss on this contract. So this for you may be more affordable. If the stock at expiry is above the short strike, that is 1480, your gain will equal the spread minus your debit, and in that case that is $5.35, and that is your maximum gain. Here you can see where someone who couldn't afford simply to buy a Tesla call might choose this strategy instead. That's because the cap substantially reduces the cost of your bull leveraged trade. It does cap the gain you can make, but it also substantially reduces the cost of the trade. Now, in this example, we have to give a warning. There is some assignment risk with this kind of debit spread, and it's considerable because of the high price of the trade. Normally, you would go into this trade with a spread bet. In other words, you wouldn't necessarily exercise this one leg at a time because you couldn't afford to do it. So in accordance with the instructions provided by your broker, you would submit a spread bet. Although this has a low probability, if the stock goes above 1480, the counterparty has the right to exercise at any time. Now, they're normally going to wait until expiry to do that because that's where they're going to get the most value out of it, but they don't have to do that, and they may not do that. And if that happens, you would have to exercise your 1470 immediately to comply because you don't have the cash to cover the assignment. This risk is substantially reduced if you exit the trade the day before expiry, but this does not entirely eliminate the risk, and early exit reduces your maximum gain. And that, again, is because you are taking advantage of the premium NISTA. So here then is a summary of the strategy that we've just covered by example. The options trader doing a bull debit spread essentially buys a call, typically near the money, but out of the money. And again, this is not a hard and fast rule. There may be a reason to buy this in the money. Because she is buying a call, her account is debited for the value of the call and fees. If the option trader at this point does not have a problem of any kind, then this is the end of the transaction. She owns a long call, and her maximum loss is limited to the cost of the call. But suppose this call option is far too expensive, as is often the case with Tesla, Google, Amazon, and other high-priced stocks. Given the cash she has in her account, she can still do the trade by writing or shorting a cheaper, less expensive call that is further out of the money. On net, the short will substantially reduce her debit and the cost of the trade, but it will also cap her maximum profit. We can see why using debit spreads are justified, but maybe not so much. Let's compare these debit spreads to credit spreads for these same securities. Let's also compare what we've just done to a put credit spread for Tesla. Now, in this case, of course, we're going to use puts, but this is still a bull credit spread. And so if we're looking at Tesla at 1468, then we're going to choose, because we're using puts, two options that are out of the money and below 1468. So let's choose the 1465 and the 1455. And you can see the 1465 is represented by the red line, and the hedge, in this case, because we're talking about a credit spread, is represented by the orange line. Let's put them side by side. The new put bull credit spread is on the right, and the call bull debit spread is on the left. You can see that they're not very different, although the bull credit spread has a gain that is smaller and a loss that is larger, although not by a great deal. But because of the probabilities, the put bull credit spread is probably preferable. Because think about it, if you look at the put bull credit spread on the right, then your probability of maximum gain is higher than 50% because all of the strikes are to the left of the center and they're puts. So you have a much higher probability of a maximum gain of 485 than you do when you compare it to the call bull debit spread, because the maximum gain there, albeit at 535, is for a call that is substantially far away from the money on this. Remember, the short strike is at 1480 and the stock is 1468.75. So the put bull credit spread actually looks more attractive when you take that into account, especially considering that the maximum gain is where you start because it's a credit spread when we consider using puts to make this bull bet, as opposed to the maximum loss being where you start if you're using calls. This is one of the reasons why you're not going to use a call bull debit spread very often for much of anything, because the task can typically be performed for a bullish bet with a put bull credit spread. And this explains why those are more popular than call debit spreads. Let's conclude these examples with a put debit spread for Tesla, although this is going to be a bet that you're seldom going to make. In this example, of course, we want the puts to be out of the money. So with Tesla at 1468.75, we're going to choose 1465 as our long strike and 1455 as our short strike. We will begin with our max loss of $4.90, and that will be our initial debit. But if we are right about the price of Tesla going down, then once we get below the strike price of $14.55, we will realize our maximum gain of $5.10. So we would do this if we were bearish on a very expensive stock. But again, if it's an expensive stock, you can consider the alternative, which is a call bear credit spread. And that's going to look better than this in most cases. Now, so far we have discussed general circumstances under which you would choose a certain strategy. But how do we specifically choose when to do this and at what strikes and prices? First, genuine strategy requires deeper treatment that we're going to offer here. As I've said, we must return to our models, including the distribution mappings. And we have to remember that these are gambling tranches, no more, no less. You shouldn't have to be told that none of these are profitable all of the time. And our standard that we have to beat is the S&P 500 Sharpe ratio. You have to find the right strategy in the right context. You have to find the right underlying. No strategy is universal. And these options have to be priced right for this trade to be profitable. You must understand the true risk parameters and the extremely asymmetric payoff patterns of competing strategies. That should be evident in looking at these mappings. There's copious misinformation out there about risks of various strategies, especially on YouTube and social media sites. And there is absolutely no a priori guarantee that any of these applications have a positive expected value unless you can demonstrate why that's true. In the next video, we're going to specifically go back to our models and price out these various option combinations. Okay, here are some key takeaways that you must understand. And here we're talking exclusively about debit spreads. 1, a debit spread is a two-legged bet and both options are the same. That is to say, you're talking about calls or puts. 2, whether calls or puts, the primary bet is bought, buy to open, close to the money, and the second option is sold, sell to open, more distant from the money. Because of point 2 above, the account is debited at origin. 4, the distant option is not a hedge, it's a cap. 5, a call-based bet is bullish, and a put-based bet is bearish. That's the opposite of credit spreads. 6, both calls originate out of the money usually, but there are reasons to place the primary bet in the money at times. 7, These are justified on options that are very expensive because the cap cuts the cost. 8, you make maximum profit only if you hold the option to expiration, but 9, this introduces assignment risk, which can get expensive. And so that, in summary, is what we have learned so far about debit spreads. Here I have a slide that I'm not going to cover in this video. It's here to remind you that you have this available in the PDF version of this video file, which is a summary that contrasts the debit spreads and credit spreads so you can see it all on one page. It would be tedious for me to go through this on this video. So that's all we're going to have to say about debit spreads and their primary uses. In the next video, part 7, we're going back to the models to price out the tranches that are implied in these strategies to see when the execution of a strategy is justified and when it is not. Until then, happy trading.